At the local level, ultimately with free-flowing credit, far too many mortgage loans were made to people who had no chance of paying them back unless market conditions remained the same for a long time. Market conditions changed for the worse. Far too many lenders were issuing adjustable rate mortgage loans with low teaser rates. Borrowers were told they could simply refinance in the future at a lower rate. This assumed property values would continue increasing. Values dropped and credit tightened. These were bad loans to begin with, and the phrase predatory lending was born. Far too many borrowers were given mortgage loans with little to no underwriting. That is, no or bad credit was fine. Stated income, no problem. One of the drivers for this bad behavior on the part of the lenders was commissions being paid to the loan officers without regard to how solid the loan was. On top of these questionable practices, we had a Congress that was pushing the industry to make affordable housing readily available to anybody who could fog a mirror. Individual banks rely on volume to make money. They make a little money off of each mortgage loan. Sometimes they make a lot of money off each mortgage loan. They make even more money off a portfolio of mortgage loans. Buying and selling of portfolios was and remains commonplace. There was federal government involvement in 2007 and 8. They were certainly not blameless. There are several articles in the text of this web post, one specifically under President Clinton, one under President Bush. Both parties stand blameful, not blameless, for what happened. Meanwhile, on Wall Street, portfolios were being purchased and bundled together in bonds and bond funds. These were packaged into what's called a collateralized debt obligation, or CDO. And they were collateralized into bigger and bigger portfolios, with commissions being paid at each level. If you're interested in more details, read the book The Big Short or see the movie The Big Short. Then there are the ratings companies, Standard & Poor and Moody's. They were giving AA and AAA ratings to the above-mentioned bundles, even if a small percentage of contents of the bundle were good. That is, bonds and CDOs that contained mostly bad loans were being rated highly by both ratings companies simply because they had a percentage, not even a high percentage, of good loans in them. People should have gone to jail over this, but they did not. Will this happen again? No, not at least the same way. Several things have been put into place to prevent the same sort of debacle. Between the Dodd-Frank legislation and the SAFE Act, that's SAFE, borrowers and lenders have some measure of protection. For instance, when creating a mortgage loan, the lender must be able to show that the borrower can afford the payments. See Title 14, Subtitle A of the Dodd-Frank legislation. The use of an RMLO, a registered mortgage loan officer or residential mortgage loan officer, to create the loan, and a reputable servicing company to service the loan are also huge factors that partialnotes.com considers when determining whether to create or purchase a mortgage note. See our guidelines for creating new notes at www.mortgageplanb.com. Recent legislation went into effect on 1 May 2023 that stipulates a fee will be charged to people with good and great credit who are getting new mortgages. This fee will be redistributed to people with poor and fair credit to help enable them to purchase homes. The reader is left to decide for themselves whether this is a good idea or whether we are recreating an environment wherein homeownership is being granted rather than earned.